Hey everyone, today we'll be going over what a convertible bond is with in-depth examples and a case study all under 15 minutes, and without any further hesitation, let's get started. A convertible bond is a type of bond where an agreement between a business and the investor agree to have a type of bond which can either be treated as a standard bond or be converted into equity. The components in order to create said convertible bond are the following. 1. Needs a principal face value, where the amount of a single bond will cost, the coupon rate, indicated as the interest rate, maturity date, conversion ratio, conversion price, conversion period, call provision, put provision, yield to maturity / yield to call. And say, for example, we have a company issuing a convertible bond and they are looking to raise $2.5 billion with the predetermined plan to allocate resources and infrastructure with stable recurring revenue prior to going public on a stock exchange and issuing their shares to the public. During seed and Series A round of financing, let's say that the company issues a single bond worth $1,000 at face value. The convertible bond is indicated in this set structure. The total offering for capital that the business is looking for is $2.5 billion. Face value per bond is going to be $1,000, and the number of bonds issued would typically be about 2.5 million, and their coupon rate, which will be paid annually or can be paid quarterly, would indicate an attractive rate to entice investors before conversion. The convertible bond has a maturity period of 7 years until it can actually be converted into equity or be paid out fully in its face value, and the conversion ratio, which indicates how much of equity can the bond be converted into, would indicate as 40 shares per bond, and the conversion price would be when the share hits a price of $25 fixed. Then there's a conversion window which starts after year 3 to allow bondholders to convert once company nears IPO in an initial public offering, and then there's a call provision which is callable at $1,150 per bond, where we have a 15% premium over the face value after year 5. And the put provision would indicate for the bondholders' ability to sell back their bond at face value, indicated as $1,000 after year 4 if the company delays its IPO. Meanwhile, the calculated percentages for yield to maturity are respectively 7.98% and yield to call will be 8.52%. Now, we first need to ask ourselves, how are convertible bonds actually determined? Well, it's mostly related to the company's finances, where specifically companies with strong credit ratings can offer lower coupon rates because investors see them as lower risk. And if a company has higher debt or weak financials, it may need to offer a higher coupon rate or provide better conversion terms to attract investors. And Dun & Bradstreet is typically used to determine a business's credit worthiness. Here are the following indicators that Dun & Bradstreet uses to assess a business's creditworthiness. First, indicating by the financial strength indicator, which is based on net worth and issue capital. So it ranges from 5A, which will indicate 50 million and above, all the way to O, which means financial strength completely unknown. And there are also risk factors also associated with said Dun & Bradstreet score, which range from 1 to 4, which indicate a scale for a business's risk assessment, 1 being minimally risky, and then 4 being significantly risky. And then there are other standard de facto scores that are indicated inside of Dun & Bradstreet, such as the PAYDEX score, Delinquency score, Value score, and SER rating, and maximum credit recommendation. Then with the combined D&B rating, here the letters are indicating the financial strength going all the way up from what we recommended from 5A all the way to O, but also indicated between A, B, and C, etc. And we also will go back on our risk factors between risks 1 through 4, and we can even see in our example over here over this following business's own D&B rating. Here we see 3A and 3. Now, in the context of a convertible bond, we would have to first indicate the financial strength and creditworthiness of the business itself. There are companies with strong net worths and cash flow, therefore can issue convertible bonds at a lower coupon rate due to lower risk. And a high D&B rating, which would be indicated as 5A1 or 4A2, indicates strong financial stability and attracts institutional investors. And firms with lower financial strengths, such as C3 and D4 ratings, may need to offer higher coupon rates or add protective covenants to attract investors. Then with the PAYDEX score, companies with a high PAYDEX score of 80 plus determine a strong repayment history, making it easier to issue convertible debt at a favorable rate. And if a firm has a low repayment score, which is typically below 50 under PAYDEX, it may need to offer higher yields to compensate for credit risk. Then in the context of conversion terms and market conditions, we have to set the conversion price, which would be set above the current stock price to incentivize investors while protecting existing shareholders. We will also have a conversion ratio, which would determine the number of shares per bond, such as, for example, one bond is equal to 40 shares at $25 at the conversion price. Then we also have to consider market volatility, where companies in highly volatile sectors may offer higher coupon rates or protective clauses to attract buyers. And then the maximum credit recommendation, which would be under Dun & Bradstreet, and the bond size. Dun & Bradstreet's maximum credit recommendation helps determine how much debt a company can safely issue. And for example, we would have a company with $180,000 credit recommendation, which would struggle to issue a $500 million in convertible bonds without strong collateral or institutional backing, which is essential for convertible bonds. If we were to see a more in-depth example, let's say, for instance, we have company A with a strong credit rating from Dun & Bradstreet of 4A1 and a PAYDEX score of 90+. They have a bond offering going on for $500 million with a coupon rate of 4.5%, which is low due to strong credit rating. And then we have a conversion price of $30 per share at 20% premium over the stock price. And the conversion ratio will be 33.3 shares per bond, which would be indicating for every single $1,000 bond would be $30 at the conversion price. And then the call provision would be callable after 5 years at 120% of face value from its initial bond, and then the put provisions where the bondholder can sell back at face value after 4 years. Then company B, on the other hand, where they are indicated with a weaker credit rating from Dun & Bradstreet, which would be B3 and a PAYDEX score of 60, they would have a bond offering of $250 million with a coupon rate of 7.5%, which is typically higher due to credit risk, and then conversion price would be $20 per share at a 10% premium over the stock price, and then its conversion ratio would be 50 shares per bond, which would be indicating for every $1,000 bond can be converted into shares when the stock price hits $20. And the call provisions would be callable after 7 years at 115% of face value, and put provisions where bondholders can sell back at 95% of face value after 3 years. Overall, a high D&B credit rating allows companies to issue bonds at lower interest rates while setting more favorable conversion terms. And PAYDEX and risk scores affect investors' confidence, where companies with poor repayment history must offer high-yielding or productive clauses. Then the company's market position, net worth, and stock price influence the bond structure in total, which are going to be including the conversion price, ratios, and call and put provisions. Now, if we were to go over the legal framework for convertible bonds, we will have to understand really over what context it will be set in place, since convertible bonds can also be sold in both primary and public offerings as well. So in the context between primary regulation, where convertible bonds by nature are governed primarily by contract law, not SEC regulations, which makes them attractive for businesses to be able to issue said bonds. And the indentured agreement defines a bond's key terms between two parties, between the investor and the business, where the conversion ratio and price is already set, along with the coupon payments, maturity date, call and put provisions, and an anti-dilution clause, since there will have to be some collateral to structure the bond. And meanwhile, if a company were to issue convertible bonds and notes in a public setting, they would have to implement and abide by the SEC regulations, where if issued publicly, companies may need to disclose bond terms in their S1 or 10K filings for public companies, or quarterly and annually reports if during a traded agreement. And if the bonds are issued privately, institutional investors under Rule 144A, the SEC regulations do not apply. And for convertible bonds in the legal framework, there is investor protections, which are based on the bond agreement, since they abide by contract law in its first primary setting. There is the anti-dilution protections, which prevents stock dilution from additional share issuance, and default and bankruptcy protections, which convertible bondholders are creditors before equity holders, and conversion mechanisms, which would be dictating whether conversion is optional, mandatory, or contingent. And in the context of market regulations, convertible bonds may be listed on bond markets such as the New York Stock Exchange or NASDAQ if structured for public trading, and trading is subject based on exchange rules, but not SEC oversight like equities. In the worst case scenario for convertible bonds, there will be these 5 indications. 1, typically there is rising interest rates, which would reduce the bond's value. If interest rates increase, existing convertible bonds with lower coupon rates may become less attractive, since directly from the Treasury, if we already have interest rates of 5%, people would abide by bonds that would be issued at 5% from the Treasury, and this can lead to price drops in the bond secondary markets, but cause investors to sell at a discount. Then stock dilution from additional issuances, and if the company issues more shares, it dilutes the value of existing shares, making conversion less attractive. And some bonds include anti-dilution protections, but these do not always fully prevent the losses if a company issues more shares. There's also the context of stock prices never reaching the conversion price, and if the stock price remains below the conversion price, bondholders cannot convert for a profit, and the bondholder is left only with the fixed coupon payments, which may be lower than the regular bonds. And then there's also the company declaring bankruptcy or defaults on their debt. If the issuer goes bankrupt, bondholders are repaid after secured debt holders before stockholders. And in liquidation, convertible bondholders may receive only a partial repayment or nothing at all if assets are insufficient. And then finally, there's forced early redemption, which is a call provision. If the issuer calls a bond early, bondholders may be forced to convert or redeem at a set price, potentially losing out on future gains as well. For example, if a bond is callable at $1,150 per bond, but the stock price is trending up, investors might miss out on further appreciation. In the best case scenarios for convertible bonds, we would indicate these 5 points. 1, if the stock price surges above the conversion price, that is a positive, because if the stock price rises significantly above the conversion price, bondholders can convert and realize larger profits. There's also safe fixed interest payments with equity upsides. Bondholders receive steady coupon payments while maintaining the option to convert if the stock appreciates. And even if the stock underperforms, they still earn interest income, providing a safety net. Then the third point would be a no early call, allowing full upside capture, where if the bond has call protection, the company cannot redeem it early and allow bondholders to fully benefit from stock price increases. And investors are protected from forced early conversions at an unattractive price, such as, for instance, if a bond with a $40 conversion price is set to maturity in 10 years and is not callable for the first 5 years, the stock rises to $120 by year 6, and since the bond cannot be called early, the investors holds longer and converts at a much higher profit. Then the next part will be favorable market conditions with low interest rates and bullish sentiment. If interest rates remain low and convertible bonds retain a high value, therefore they will attract more investors. And a strong bull market increases demand for conversions, boosting bondholder profits. And if a company acquisition or buyout occurs at a premium, the issuing company is acquired, meaning that the convertible bonds that may be bought out at a premium or automatically converted into the company's stock, which investors benefit from merger-driven stock price appreciation. Such as, for an example, if a bond with a $50 conversion price is issued and then the company is later acquired for $90 per share before the bond matures, convertible bondholders convert and gain a near double return on investment. And to look at a case study, we can look at Amazon in particular. For Amazon, after they went public in 1997, issued convertible bonds, which were issued to expand Amazon's infrastructure using the stock as collateral for equity. In January 1999, Amazon.com issued $1.25 billion in 4.75% convertible subordinate notes due in 2009. So the maturity date was 10 years, and each note had a face value of $1,000, resulting in the issuance of 1.25, and these notes were convertible into Amazon's common stock at a conversion price of $156.05 per share, representing a 27% premium over the closing stock price at that time. And the offering was initially set at $500 million, but due to strong investor demand during the time period, it was increased to $1.25 billion. The notes were sold to qualified institutional buyers in a private placement under Rule 144A and Regulation D of the Securities Act of 1933. And Amazon's 1999 convertible bond issuance indicated the birth for AWS. After the whole structure between the amount raised and what the capital was actually used for, aside from databases, warehouse, and logistics, they ultimately expanded to be able to create AWS, and AWS became Amazon's most profitable division, generating billions in annual revenue today. And convertible bonds are beneficial because, for investors, there's downside protection with steady income, there's liquidity and exit options, there's lower risk than stocks and higher potential than bonds, there's an inflation hedge and better recovery and market downturns, convertible bond appreciation, and equity upside potentials. And for businesses, they also present a lower interest cost and attract a broader range of investors, flexibility with market conditions, encourage long-term investments, and potential debt reduction. Overall, making convertible bonds an equitable and smart investment strategy. Hey everyone, thank you very much for taking time to watch this. If you found this video helpful, be sure to feel free to please like and subscribe. And if you have any other questions, please put them in the comment section. And as always, take care. Cheers. Bye-bye.